You're listening to the Savings Tip Jar with Dom Beattie and Denise Raywood, brought to you by Savings.com.au, your home of savings news, guides, and product comparisons. Hey, how you doing? How are your dollars? Feeling the pinch? A lot of us certainly are, or will be soon, especially after this month's RBA rate hike. Regardless, it's great to have your company for another episode of the Savings Tip Jar, episode 151. I'm Dom Beattie, the editor of Savings.com.au, alongside our senior finance journo Denise Raywood to help break down the week's main money matters, including the big one, the RBA's decision to lift the cash rate for the third time in a row, plus the slowdown in the property market and a new tax offset that's rumoured to be in the federal budget. After that, we'll get an expert reaction to the RBA decision from Dr. Susan Stone, who's the chair of economics at Uni SA. Looking forward to that one. And as always, we'll each share some savings tips. Hello, Denise. How are you?
Good morning, Dom. I'm well, thank you. Big day yesterday and just dealing with the fallout, I guess.
Yes, certainly. It's definitely a big couple of weeks in Aussie finance with the RBA decision this week and then next week the federal budget. But before we get into all that, let's start off as we usually do with our savings tips. What have you got for me this week, Denise?
Well, it's, a third rate rise in a row. It got me thinking what's some smart things that we can do to on a week-by-week basis, reduce some of our costs. So it got back to food again for me, Dom. The other thing that brought this one to me was the changing of the seasons because, of course, we're going to start getting our first cold blasts in Australia. Bit of rumours of snow might be on the mountains, a few frosts that people will be getting for the first time. And to me, that means seasonal fruit and vegetables. This is a way to keep your costs down. You buy what's plentiful and cheap and in season. I'm in southeast Queensland, so we start to see the humidity go, and that means things like citrus fruits. So instead of buying your same old apples, whatever, switch over to mandarins and oranges. They're going to be cheaper and they're going to be not far off the tree, and they're going to be better for you as well as saving you a bit of money. Vegetables, it's, I know kids don't like these, but it's the broccolis, the cabbages, the kales, the Brussels sprouts. You'll find big bags of these, also peas. My mum is just, she's from a certain era and she saw a massive bag of snow peas for $3. She could not help herself. She's a woman that lives on her own. She's never going to eat a massive bag of snow peas, but she couldn't help walking past a bargain without picking it up. And I just thought, it's actually a very good way to save money week to week. Just eat what's in season. They're cheap at the markets. You probably won't find them so much at Coles and Woolies because they're very reliant on Coles stores for a lot of things, not everything. But if you go to your independent fruit and veg, those sort of grocer type people, they're more in touch with what's in the markets every day, tend to be a bit more responsive with price, and of course farmers markets and just markets in general. That's my tip. Just go seasonal.
I love all your food savings tips, Denise. That seems to be a common thread with yours. It's always food related, but that's good. Obviously, food is one of the biggest costs of our lives. I love that one, and particularly, I'm not totally abreast of which foods are in season when. I didn't know that oranges come into the colder months, so that's good to know. I mean, that explains why when I'm looking at the oranges, that there's none that are from Australia. They're all coming from America. So and they haven't been that great lately. The ones I've been buying. And I haven't been able to get mandarins anywhere. So until now, I've seen them on the shelves. So. That's great to know. So I'll definitely snap some up. We're a big fan. Actually, I should know this because I've just noticed because we planted a tiny little mandarin tree, just a little dwarf one. It's not growing very well, but I've just seen there's been one mandarin that's been very slowly growing and it's finally turning orange. So, it's got just one. We'll get one mandarin out of that tree this season.
Don't forget that there's, the different parts of Australia. It's a very big continent. So I'm sort of talking about what we see in southeast Queensland, which is where I'm from. But it's really good practice to know what is in season at certain times.
Oh, for sure.
Not only just for nutrition value, but also for saving money. It's get a little bit more in touch with, we're going to see fertilizer prices go up a lot. So it's always good to know what grows at a certain time naturally, and keep yourself in tune with that. That's how humans are designed. We get certain nutrients at certain types of the year, and it does us good in a lot of ways.
Yeah, definitely. Yeah, no, these grocery price hikes are coming, unfortunately, as last week's episode featuring Joel Gibson touched on, where he pointed out how milk is the canary in the coal mine, and milk's gone up, so that dairy is usually the first thing to go up. So then it'll probably be fresh produce, and then packaged goods a bit later on. But certainly with things like higher oil prices, and fertilizer prices and whatnot. So not looking forward to those price hikes, but you get the sense that they are coming. My savings tip this week, not food related, very different. This one is for all you credit card points nerds out there. And this is an offer that I look for every year, because typically we see it on offer in, I think it's usually May and November. And so I did just check this morning. I was like, hey, it's May. Does that mean that Velocity, which is my preferred airline partner, is offering that points transfer deal? And I can confirm that, yes, they are. So essentially what this one is if you have a credit card and you earn credit card points with that isn't, Velocity points, say they're just, say you've got an ANZ card and you earn these ANZ rewards points. Often you'll find, a lot of credit card points enthusiasts know this, you get much better value out of these credit card points if you transfer them into Velocity points. And a lot of them are partnered up with Velocity that they allow those points to be transferred. And we know that these points you get much more bang for your points by claiming them and using them on things like flights than you do, buying a set of steak knives from the ANZ rewards store. It's much better value for your points if you're using them towards flights. So that's why I try to transfer them all into Velocity. But as to what the special offer is, they're offering up to 20% bonus Velocity points for those points transfers this month. But just getting into the specifics of that offer, it's 10% bonus points if you do a manual transfer with one of those participating transfer partners at least once per month in May and June. So you have to do it manual transfer in May and another one in June to receive 10% bonus points on the transfers during those months. Or you can get 20% bonus points if you opt into an auto transfer with one of those partners and keep the auto transfer on until at least the 30th of June 2026 to receive 20% bonus points on your transfers during May and June. So I'm just going over who those participating cards are. For the manual transfer, it's the usual ones: Amex, ANZ Rewards, ANZ Business Rewards, Bank of Melbourne, Bank SA, BOQ, My Card, which is the one that Citi has become, which is My Card, actually, literally My Card, because I had a Citi card before, has now become a My Card, which is actually owned by NAB. But yes, NAB is part of it as well, and St. George and Westpac. I think it's the same partner. Oh, no, it's not for the auto transfer. It's slightly different. ANZ Rewards, ANZ Business Rewards, Bank of Melbourne, Bank SA, My Card, NAB, and St. George. So the only one that's missing from the auto transfer offer is, as far as I can tell, BOQ and Westpac as well. So it looks like those two will just get the manual transfer offer of 10% bonus points, but up to 20% for those other ones I just mentioned. So glad to see my credit card, My Card, is on that auto transfer offer, because I will be looking to take advantage of that, because I have really stacked up some serious credit card points in the My Card, and I actually missed out on this offer last time around because it was a tricky period. I think Citi was transferring into My Card, so it just wasn't part of it. But yeah, I've got a fair few points stacked up that I'm looking to transfer into Velocity points to hopefully use someday soon on a big trip, whether that's domestic or overseas. I don't know what you think about it, but I'm saving up those Velocity points to one day.
That was my question, Dom. Where are you going to go?
I don't know
they're only
yet.
Good value if you use them.
I know, and I will use them at some point. But yeah, I just like at the moment just seeing all the places that we can go with my current points balance. I'm like, oh my God, I've got enough points now to fly both of us to Samoa or Hamilton Island, or not quite enough to go to places like San Francisco or London or anything yet. But it's getting there. It's getting pretty high, that balance. And that's because we do pretty much all our spending on this credit card, just to maximize our points earning, and also sort of to keep as much money as possible in the offset account. But we do ensure that we do pay off the credit card every month, so that we're not getting hit with interest.
That's the secret.
Yes, that's my savings tip is take advantage of the bonus velocity points offer on transfers, credit card points transfers this month. All right, we should probably get into the news for the week. Denise, we'll start off with the big one, the RBA.
Yes, the RBA. That is the news of the finance world this week, I guess. The Reserve Bank of Australia has decided to raise the cash rate by 25 basis points to 4.35%. That's up from 4.10%. And it's the third hike to the cash rate for 2026. So it effectively wipes out all the three the cuts that we had in 2025. We're back to where we started at 4.35%. And we had increases of course, in both February, March and May. And interestingly, 8 members of the 9-member Monetary Policy Board voted in favour of increasing the cash rate to 4.35% in May. Only 1 member voted to leave it unchanged. So we had a bit more, I guess, a consensus this time than we saw in the last meeting, when it was 5 votes to 4 for the cash rate. Of course, we've had the conflict in the Middle East since then, and that put a whole new slant on looking at the figures that the RBA normally looks at. There was the uncertainty surrounding the war in the Middle East featured prominently in Michelle Bullock's, that's the RBA governor's press conference afterwards. And, it's safe to say that it will be closely watched. We've already seen the big 4 banks and Macquarie Bank pass on those hikes to their variable home loan rates. Macquarie's also told us about the savings hikes as well. They tend to be passed on a little bit later on. So if you've got a home loan with, the big 5, you'll be paying more, and you'll be hearing from your bank about that soon. You'll be used to it because it's happened a couple of times already this year. So we'll talk a lot more about the implications of that, as you said, Dom, with our guest.
Yeah, certainly. It was interesting seeing that breakdown in the votes. It was such a such a tight one last time around with 5 to 4, and now it's swung out to 8 to 1. I wonder who that one person was. How funny would it be if it was Michelle Bullock? It was the one dissenter saying, no, we should hold. She'd just be like, well, you guys all suck.
We never know. We'll
never know. Obviously, they've got to keep all that private, but we're allowed to speculate, as unhealthy as that may be. But I mean, I think last time around, I think that the war actually had sort of just kicked off last time around, and I think there was so much uncertainty. People thought we might actually be like heading for a serious recession right now. Maybe we shouldn't be doing a hike yet. But then now it's kind of dragged on a bit. I don't know. I guess people have had more time to digest the potential implications of the war scenario, and maybe those other board members have decided, okay, well, yeah, maybe we should be hiking because inflation is going to get away from us. But yeah, no, good to see already a couple of announcements of banks that will be passing the hike on in full to savings accounts. That's what I mean. It's a good thing. Obviously not so good for borrowers. But I mean, the likes of AMP Bank Go, that's quite a popular one at the moment because it's one of those non-conditional savings account rates and a pretty high rate at that. And they're passing it on in full effective on the 11th of May, which is pretty prompt because you see some that won't pass it on till, I think it was Teachers Mutual Bank not passing on the hike till the 1st of June to savings accounts. But that's a good thing for home loan holders there because they're not getting the hike till 1st of June as well, which is fair. But if you've just got a savings account with Teachers Mutual Bank, you might not be too happy with that. But not a surprising one though. I think we're all expecting that. I think the next one is a bit more up in the air. I think it's probably like each of the big four banks. I reckon there's going to be a hike in August. But as for whether there's one before then or after then is more the bigger question. So we'll see how that one plays out. But looking forward to chatting some more about the RBA decision with our expert this week, Dr. Susan Stone. Moving on to the next story on the agenda, and this one is a bit of a budget scoop, budget rumor that was landed by the Australian economics correspondent Matthew Cranston. And this one's pretty interesting because it's essentially what's called a earned income tax offset of between $200 to $300 for every person in Australia who gets a wage or salary and pays tax. So this is what's set to be announced in the federal budget if these reports are correct. This one's it's a bit like, if you think about the what we nicknamed the Lamington, the low to middle income tax offset, which was much more generous. That was I think $1,080 up to $1,080. But that one would apply to just pretty much everyone. Whereas this one only applies to earned income as opposed to income from investments and sort of that sort of passive income. It has to be income that you actually earned by working, essentially, and it's obviously much less. It's rumored to be $200 to $300. Now this one, it's. I feel like a lot of economists probably would not like the sound of this one because a lot of them keep warning that the government just needs to really sit on their hands as much as possible through this budget and not give any sort of goodies to households because it's just going to make inflation worse. So obviously it's not as generous as the Lamington, 1,080. That would have been very inflationary, but this one, $200, $300, perhaps just a little inflationary, might be a bit more palatable for some economists. I do like that it does apply to just people who are working and earning salary as opposed to passive income, and also just those that pay tax. So it means retirees probably will miss out on this one. But regardless, it'll still cost the budget a few $billion. So what do you make of that one, Denise, that rumour?
I could see the logic behind it. It's probably, it is targeted at wage earners by the sound. I don't know. We'll have to wait and see until the budget, I guess. But, a lot of the things that get leaked out at this stage do sort of tend to find their way in there somewhere. It was interesting yesterday in the media conference after the RBA. I thought Michelle Bullock was probably, the most upfront that she's been in the times that I've been watching her after these RBA meetings in, sort of not warning the federal government against the handouts, but being quite firm about the general principles of, towing the line with what the RBA is trying to do, I guess, keep inflation under a bit of a lid. And, be interesting to see, as you say, I don't think that is as bad as some of the previous budgets that we've seen from Jim Chalmers. But it's, and when I say as bad, I mean as bad for inflationary pressures, probably good for people like us, wage earners. It's all wait and see, and it's less than a week away now, the 12th of May, the budget. So, I'm quite interested to see, what's contained in this one, as well as all the, the capital gains tax and negative gearing changes, and, apparently some change to trusts as well. So, the devil is in the detail.
Oh, for sure. Yeah, there's never a truer word has been said in regards to this budget because, we can speculate as much as we like about what's going to be in it. But, we have to really wait until we have all the details Not long to go. Just under a week away now. So, and of course, to all listeners who are keen to be across everything that's in the federal budget, Savings.com.au will have a full suite of budget coverage on budget night. We'll be publishing a whole series of articles. What's going to be in the budget for pensioners, what's going to be in the budget for homeowners and home buyers, what's going to be in the budget for parents, you name it. So definitely check out Savings.com.au on budget night for all the ins and outs of the federal budget. I think we've got one more story to cover, Denise. Property market. You were looking at this one just last week.
Yeah, it was sort of last week we saw it roll over to the 1st of May, which means that we get to look a lot of the monthly data that's been collected by our property data agencies. And there was actually quite a few reports that came out at much the same time, and they said pretty much the same things, that we're seeing that the property market in Australia is losing steam generally on a national basis. And of course, some markets are hit harder than others. And once again, that we've seen property prices are falling. The growth has slowed much more in the Sydney and Melbourne markets, which are Australia's two biggest property markets, our biggest capital cities. And we're seeing even prices in places like Perth. They've been on a tear for quite an extended period of time. Even they're slowing down as well as Brisbane and Adelaide. The growth is slowing in the market. Pretty much they agreed that we can expect to see, I noticed Catality brought out yesterday just a little statement delivered after the RBA decision that it would expect after a third interest rate increase in 2026, it'll further dampen the housing market. Now, this could be good news to some people who are looking to get in. It's not the same breakneck pace of price increases and feeling like you're pressured to sign on a dotted line, otherwise you miss out. That will suit some people well. Of course, people are looking at selling, that could even include people who may be struggling to take on board a third interest rate increase. It's not so good times. So basically, I think it was Cotality's research director, Tim Lawless, said the easing in market conditions has sort of seen sentiment has fallen off a cliff. And, you can see why 3 interest rate hikes would do that. And also a bit of rising inflation thrown in there. So it means that other costs are going up as well as housing costs. And it's a very, probably a tricky time for, I particularly worry about all the younger, perhaps home buyers who've got in on the expanded 5% deposit scheme, which was expanded on the 1st of October last year. We saw quite a lot of uptake of that in the early days. And of course, 5% deposit is quite low equity to start out with in buying a home. It's a bit of a rough initial ride into home ownership for people, buying at that time. And, I guess we see how all this plays out. Uncertain times for, the economy and the housing market. So, we'll wait and see what happens. I think the markets outside of Sydney and Melbourne, have still got a bit of growth in them. Sydney and Melbourne, the prices are going backwards in some of those suburbs. So, let's see what happens.
Yeah, I wonder if this is, is it a healthy correction? Property prices can't keep rising forever. That's no good. And I don't think many people really want that. Just looking at the breakdown of the data there, like it's still seeing like Brisbane, Adelaide, Darwin, Perth, still above 1% for the month. That's like 12% a year. That's still pretty rapid property price growth there. And Sydney and Melbourne, though, obviously, going backwards. You wonder with Sydney, that's probably a healthy correction there, given prices just they're pretty outrageous in Sydney.
It's its own market, It's quite apart from,
But Melbourne, though, is kind of interesting because it's actually become one of the more affordable markets these days, and they really haven't really had much growth, particularly when you account for inflation over the last 5 or 6 years, you really haven't really made much of a return at all there in Melbourne if you're a homeowner there. So a lot of homeowners there probably wouldn't like that too much. But then at the same time, a house is a place to live. So investors, I guess, primarily would be the most concerned. But people who happy, not looking to sell anytime soon, happy living in their current place, shouldn't bother them too much. But I guess there are sort of things like that maybe you'd be prevented, won't be able to do so much of, such as borrowing against your own equity. You can't do that as much if your property price hasn't gone up in value too much. Of course, and then recent home buyers taking advantage of those home guarantee schemes, buying with only 5% deposit. Suddenly, your stake in the home might be less if it's gone backwards. You might be in negative equity, particularly if you only got 5% equity when upon purchase. So, it's interesting one. But I wonder, is this just the interest rate hikes weighing on demand, or are we actually seeing supply finally starting to catch up? It's probably a bit of both, I guess. Obviously, there's a lot of supply coming on. I think particularly in Melbourne, everyone keeps talking about how Melbourne is getting a lot of supply. I wonder what they're doing differently compared to, say, Brisbane, Adelaide and Perth. Perth, still rapid growth there, 2.1% for the month. Just looking at the annual returns, what that means. 26% for Perth year on year. That's crazy. Brisbane, 19.7%. Darwin, 19.6%. Darwin has been so quiet for so long, and then now it's rapidly picking up. The common theme there is affordability. So long, Brisbane, Perth, Adelaide, Darwin were the more affordable places to buy property. But now a lot of those cities, if not already, have overtaken Melbourne in terms of sort of median property price. But Melbourne's still lagging behind even Sydney on annual growth, 2% versus 4.2%. So interesting to see how it plays out. Could just be a temporary blip in the long-term trend of property prices going up. But I was at a business breakfast, and there was an economist doing a presentation that was quite sobering for me, pointing out I think it's the value of property to GDP. It was like some sort of ratio he's presenting in Australia, and just showing how that has changed over time, and it's just gone from like 1% to 4 or nearly 5%, just getting out of control. Whereas you compare that to America thinks they're going through a housing affordability crisis at the moment, but their property value to GDP ratio has just really sort of bumbled along around sort of between 1 to 2% for the last 10, 15 years. Whereas ours is just getting out of control, just skyrocketing. So that was quite telling, I think, of the crisis, the sort of issue that we have in Australia with property. All right, I think that wraps up the main money matters for this week's podcast episode. So now time to talk to our expert guest. All right, for this week's Dollar Dialogue, we're going to talk some more about the RBA rate hike, but this time we're going to hear from an expert, and that's Dr. Susan Stone, who's the Credit Union SA Chair of Economics at Adelaide University. Dr. Stone, welcome to the Savings Tip Jar.
Thanks for having me.
Now, before we get into our discussion of the third rate hike for 2026, let's have your savings tip, Susan.
Well, it is a bit boring. I just make sure I pay myself first, because you tend to spend what's in your account. So if the first thing you do is just have an automatic savings amount coming out, you just make do with what's left.
That is a classic. Yeah. And as we know, it works.
Yes, that's it. Tried and tested, an oldie but a goldie. It's always worth reminding our listeners of that one. Just straight off the top, what was your reaction to the RBA decision for this month? Were you surprised? Was it something you expected? And also, not only the decision itself, but also the way the governor, Michelle Bullock, spoke afterwards. Were there any sort of interesting clues or tidbits from that you took away?
Yes, I was not surprised. I think people were pretty much expecting it. Even without the war in the Gulf, there have been inflation pressures, so there was an excellent chance they were going to raise rates, if not in May, then in June. So we knew this was coming. And as Michelle Bullock said, she repeated this several times, and I think it's worth, noting, is the danger of having inflation expectations embedded in people's decision-making processes, because once that happens, it's really hard to unwind. And so I think that's why they reacted now, because traditionally they don't make a change right before the federal budget. But I think and she had noted that the fear of inflation becoming embedded, as we say, was greater than a fear of recession or another downturn happening. So that's why they increased.
We saw this time it was a 8-1 vote in favour of the increase. Any takeaways from that?
Just that it seemed pretty clear that this was the right way forward. One of the interesting things she did say was she mentioned a couple times about having policy space, which I thought was interesting, because she noted that they are expecting with the new, they've also released new forecasts. They expect inflation to peak in June, which is interesting because if the war continues and that feeds into costs, we would expect to see prices continue to rise well past June. So I'm wondering if they're expecting things not to last as long as maybe they could. Also, if they're going to give an opportunity for these 3 rate hikes to work their way through, because we know there's a lag in policy. So it could be that she's signaling a willingness to kind of wait and see, get this one in, so to speak, and then kind of they did, as you pointed out, 3 rate hikes so far in this year. It's only, May. And they're going to give those rate hikes the opportunity to do their work before considering another one.
Yeah, I think we heard some analysis from various economists saying that her comments were perhaps a bit more dovish than they had expected, and that sort of aligns with what you're saying there, that perhaps, she's going to take a bit more of a wait-and-see approach. What's your base case forecast? Do you think this hike will be enough to bring down inflation, or do you think we'll need more rate increases later this year?
Personally speaking, I'm concerned about the flow-on effects, about what's coming through, because what we've seen so far from these oil price increases and diesel price increases, really basically energy and transport, those are at the coalface, right? Those are the things that always happen first. But everybody who produces or ships goods is going to have what they're making now is going to get more expensive. And so we're not going to see that for a couple of months down the line. So I worry that this is just the beginning of price increases. Especially one of the things that I've noticed is that over time, we've talked about this being a domestically driven inflationary cycle, and that's been borne out by the numbers. If you look at tradable goods inflation versus non-tradable goods, so really domestically based produced goods versus imported goods, the domestically based goods really been driving inflation. Imported tradable goods inflation's been around 1.3, 1.4%. It's really very nothing. And this past, for these recent numbers, it was 4.5. So we're going to see increasing pressure coming from that side as well. And so even if we get the domestic inflation under control, you're not going to be able to avoid that cost push coming through. So I don't see a way around that. And I don't see a way around us not having, maybe another rate hike coming just to have to deal with that.
Yeah, I think I did hear at the media conference yesterday, Michelle Bullock, it might have been a figure of 4.8% that she thought around June, which I thought sounded quite optimistic. Do you think there's too much optimism that we got out of that yesterday?
Yeah, I was a little bit surprised at that. Well, it wasn't the 4.8% so much. It was the peak in June.
Yeah.
I was surprised that that's what they were expecting. Now, of course, a lot of their expectations are driven by what they're seeing in the market. So they're kind of using the data to drive. So if that's what the market is thinking, I think the market is expecting Trump to back down in the last couple of days. There's been a lot of change coming out of Washington in terms of the conflict or war, and So maybe markets are expecting that to wind up sooner, but I think that the momentum that's already been put in place still needs to work its way through the system. Most analysts aren't expecting oil to go below $90 a barrel until 2027. So I think there's more room for inflation to go up than down.
Now, we hear that, the RBA supposedly has a dual mandate to look after both inflation and the unemployment rate. But, I mean, these rate hikes, 3 in a row, do you think there's sort of an equal weighting given to that? Or do you think that they're really thinking, no, inflation is a real menace here. We need to get that under control first before we can worry about unemployment? Although that said, unemployment rate is still pretty low, right?
Yeah. And actually, she did say that pretty much that exact thing. She said, right now we see the risk of inflation being higher than the risk of recession. We see growth being anemic, but not negative. And so they're much more, and it is true, if you have an inflationary cycle underway, it undermines growth because businesses aren't thinking about anything other than how they're going to cover their increase in costs. And consumers aren't thinking about anything other than trying to, meet their budgets and pay their bills. And that's not the kind of economy that's going to grow or prosper or develop or grow jobs. And then add to that, as you point out, unemployment is really low. And so, we have a lot of headroom for unemployment where we don't have a lot of headroom for inflation.
Yes, interesting times actually. And, you mentioned before it's quite unusual for, a week before a federal budget to have a change like this. So what do you see for the federal budget? We sort of heard Michelle Bullock, just sort of talk very basically about, the inflationary pressures that can be unleashed by governments, which I sort of thought was interesting timing that she addressed that so directly and, much more directly, I thought, than she has in the past. So what does it mean for the federal budget? What are you thinking's ahead?
Yeah, she did, even though there were many reports that she said the government spending is driving inflation. And of course, she never said that. What she said was it has the ability to, or there's that danger of it adding to the problem rather than helping the problem, which is, of course, very true. And so, and Jim Chalmers has been saying that this was going to be a budget based on supply side issues, based on cutting, savings and cutting costs. So I was very surprised when I heard about the reports that they were going to have this tax rebate.
Yeah.
Because that's not what we've been hearing up until now. Now, of course, there's politics and there's economics, and those things aren't always in line with each other. But the point is that if they do give everybody $200 to $300, you have to ask yourself, is that really going to make a big enough difference in people's lives? And yet, what's that going to cost the government when they're trying to cut back on spending? So it'll be interesting if they do come out with that policy. They'll probably take it on the chin, I would think, for that. I'm expecting, a lot of the forecasted budget in terms of tax reform. They've already made a couple of big announcements about savings. So it'll be interesting to see if they do announce this other tax relief.
Yeah, it was certainly an interesting rumor, that one. And we spoke a bit earlier in the podcast about that because we all thought, that the government would resist the temptation to give out these goodies to households, given, they don't have an election coming up anytime soon. So, if you're going to do a bit of an austerity budget, now would probably be the time, especially considering the massive majority that this government has in Parliament at the moment. But no, this rumor's come out. I mean, obviously the devil's in the detail, and we'll see for sure whether that really is. Maybe it's just a bit of kite flying from the government right now to see what the reaction would be to something like that. But we'll have to wait and see. But that certainly would be a surprise. But not that I'd be complaining too much. But then just looking at it from an economic point of view, perhaps it's not the best thing when you're trying to get inflation under control. Dr. Susan Stone, really appreciate your time on the Savings Tip Jar podcast. Thanks so much for your insights.
Yeah, thanks for having me. It was fun.
Great to have you.
Okay.
Yes, so that was Dr. Susan Stone, the Chair of Economics at Uni SA. And that brings us to the end of another episode of the Savings Tip Jar podcast. Thanks very much for listening. Thanks, of course, to our sponsor, Savings.com.au. Thanks to our guest, Dr. Susan Stone. And thank you, Denise. Till next week, goodbye.